Michael Burry has been one of the most talked about investors over the past few years. He's not afraid to share his extreme and often contrarian points of view on the economy and the stock market. Just take a look at this tweet from a few days ago. What strategy will pull us out of this real recession? What forces would pull us so? There are none. So we are really looking at an extended, multi-year recession. Who is predicting this? There are none. Whether you love him or hate him, Michael Burry is definitely somebody who puts his money where his mouth is. Earlier this year, he sold almost every stock in his portfolio, and just last month, he tweeted this: "You have no idea how short I am." Michael Burry is actually just as short as I am, which is around 5'7". Sorry ladies, but I have a feeling that's not exactly what he meant in that tweet. I know, it's pretty easy to dismiss Michael Burry's warnings, especially since the S&P 500 just rallied by 10% over the last few weeks, and consumers spent a record $9.1 billion shopping on Black Friday. That doesn't really sound like a recession to me, so in this episode, I want to see exactly how good Michael Burry's recent predictions have actually been, and that way we can decide how seriously we should be taking his warnings about an extended multi-year recession, and the stock market collapse that he predicts will come with it in 2023 and beyond. Your time is valuable, so let's get right into it. If you're watching this video, you probably already have an opinion on Michael Burry. Maybe you agree with Elon Musk that Michael Burry is a broken clock, and he's called 10 out of the last 2 crashes. Or maybe you agree with Burry himself, who acknowledges that his predictions may be 1 or 2 years early, but they do end up eventually coming true. I actually don't agree with Elon Musk here, but before you destroy me in the comments, let me at least show you why. I think that many of us can look back and see how the US government crushed supply when they shut down the entire economy. And I think we all get how they artificially pumped up demand by printing and handing out trillions of dollars. Supplies collapsing while demand is skyrocketing is literally the perfect recipe for massive, widespread inflation, which is exactly what we got. This disaster is obvious in hindsight, but not too many people saw it coming in advance. But Michael Burry did. Prepare for inflation, reopening and stimulus on the way. Pre-COVID, it took $3 of debt to increase GDP by $1, and it's worse now. An inflationary crisis, that's what he called it back in February of 2021, which was 10 months before the stock market even peaked. The US government is inviting inflation with its modern monetary theory-tinged policies. Trillions more stimulus and reopening will boost demand as employee and supply chain costs skyrocket. Hashtag paradigm shift. I don't think that Michael Burry gets nearly enough credit for calling out just how bad inflation would get, while almost every so-called expert kept saying that it was transitory. Remember that?
If we do see that inflation expectations are moving up, or inflation is on a path to remain well above our goals and risk of setting us off on a period of high inflation, then we'll use our tools to guide inflation back down to 2%. In the end, it will be transitory, and people need to have faith in the central bank that we will do that. But we won't do it just because, we honestly, it would be a mistake to do it at a time when we really do believe, and virtually all forecasters do believe, that these things will come down of their own accord as the economy reopens.
And for the record, I'm not saying that the Federal Reserve should be acting on Michael Burry's tweets, but I am saying that 9 months later, Jerome Powell did have to admit that he was wrong on inflation, and then he began raising interest rates at the fastest pace in nearly 4 decades, which he hopes will crush consumer and commercial spending. But if the Fed had started raising rates 9 months sooner, maybe they could have at least smoothed out some of the major shocks that they're sending through the economy right now. I'm actually pretty nervous about the next Federal Reserve meeting. Sure, we might finally see a 50 basis point raise instead of 75, but the committee might also raise their projections for the terminal rate, which would mean interest rates going even higher than we expect in 2023. I'm also pretty nervous to tell you about today's sponsor, because my girlfriend watches these videos. Amar Fine Jewelry helped me make the perfect engagement ring. They actually did such an incredible job that I've used them for 3 other rings as well. So if you're looking for fine jewelry that really turns heads, here's why I think Amar is the best. First, you work directly with the owners, no salespeople ever. You consult directly with them and really dive into your project. From there, they give you a custom sketch and then a 3D CAD model to refine until your design is perfect. Only then do they source the best stones and hand make your piece exactly the way you want it. And guess what? Because they're fully remote and cut out all of the middlemen, they don't have all the costs for storefronts or salespeople. Those are cost savings that they pass on to you. That's why they're giving my audience an extra 15% off custom designs and 20% off their curated collection on their website. Just head to amarfinejewelry.com and mention ticker symbol U during your consultation, or use my code TSY20 during checkout. Now all that's left for me to do is actually pop the question. Yikes. Alright, so Michael Burry was pretty spot on when it comes to inflation, but that's only one piece of the puzzle. Another big issue that Michael Burry has been calling out is how well companies will actually perform in this economy, and the price investors should be willing to pay for those earnings. Let me walk you through those predictions as well. Adjusted for inflation, 2022's first half, S&P 500 down 25 to 26%, and NASDAQ down 34 to 35%. That was multiple compression. Next up, earnings compression, so maybe halfway there. That was from June 30th, right as we closed out the first half of 2022. But about a month later, he tweeted this: "These earnings reports, and by Jove, the whole season has a last hurrah feel." That was during the second quarter earnings season, which was actually pretty decent. So everybody wrote off this last hurrah tweet as just another hot take from Michael Burry. But about a month later, he clarified exactly why he thought that the earnings for big tech companies at the very top of the indexes would disappoint, even though they seemed fine on the surface. Subscription software and hardware revenue models revolutionized the way that business is done and made for higher multiples in the market. But this means that many businesses will show weakness later in a downturn. As we enter the fourth quarter and lap the first quarter, this should become more apparent. So software and hardware businesses tend to lock in big chunks of their revenue all at once. Think about when you buy annual subscriptions or expensive electronics that only get refreshed once every few years. Typically, a lot of those purchases get made at the end of the year. Why? Well, like I said at the start of this video, that's when the big holiday discounts take place. Black Friday, Cyber Monday, Christmas, and New Year's. These discounts really eat into a company's margins. There's also a lot of earnings weakness still to come for companies that store and sell physical goods. Think about Amazon, Walmart, Target, and every other major retailer with inventories that have been piling up for months. These inventories have holding costs, so companies want to move older products and make room for new ones. That's why Amazon had 2 Prime Day sales this year, and almost every company had steeper discounts for the holidays, all of which eat into their margins as well. And on the business-to-business side of things, fiscal years tend to end around this time. And what most companies like to do is spend as much money as they can on things that they know they'll need next year, especially if there's a solid discount. That makes their budget way more predictable, and the costs count against this year's profits, which lowers their tax burden. This is what Michael Burry is calling out here, that the stock market isn't pricing in poor end-of-the-year performance, thanks to inflation and interest rates, or that sales of physical goods could be much less profitable thanks to steeper discounts just to keep inventories moving. Everybody's just looking at nice-sounding headlines. So earnings for the current quarter and quarter one of next year could really surprise the stock market to the downside. And guess what? Michael Burry's prediction is already starting to come true. Big tech falters on dreary earnings and forecasts for quarter four. Meta Platforms had its worst week ever, and Google, Amazon, Meta, and Microsoft lost over $350 billion in combined market cap after those earnings announcements. Google stock dropped by over 20% since their last earnings call because their revenue growth came in at 6% compared to 41% just 1 year earlier. Other than the very beginning of the pandemic, when virtually every business pulled their ad spend, this was the weakest period of growth for Google in a decade, and their stock is still down over 10% from their earnings. And Amazon had it even worse. Their operating income got cut by almost half, from $4.85 billion down to $2.53 billion over the last quarter. Amazon stock collapsed by almost 30% around their earnings call, which means their share price is currently lower than even before the pandemic began. They're not even a $1 trillion company anymore. Weak. Microsoft's growth rate collapsed almost across the board. Their revenue from Office commercial products and cloud services grew by just 7% year over year, compared to 18% a year ago. Microsoft Dynamics and Dynamics 365 both had their growth rates cut in half from last year. And Windows went from growing by 10% last year to shrinking by 15% this year. What we really should be asking is why Microsoft stock bounced back so fast after this kind of earnings call. Look, these are some of the best, most proven companies in the world. They sit at the very top of the S&P 500 and the NASDAQ. If they go down, the market will go down with them. And when these stocks magically recovered some of their losses, despite their weak earnings projections, Michael Burry shared his thoughts in no uncertain terms. Did you all just mishear a death knell as a starting gun? Alright, hopefully it's clear that Michael Burry is not just a one-hit wonder who made the right call on the subprime mortgage crisis back in 2007 and 2008. His predictions on inflation early last year were spot on and very timely. I think the same will be true about his predictions on earnings for big tech companies over the next couple of quarters. That's why I think we should at least seriously consider his stock market predictions for the rest of the year and into 2023. First off, it's very clear that Michael Burry thinks that the stock market is still way overvalued. This morning, there were still 218 primary stock listings in the United States with a market cap of over $1 billion and EBITDA of less than negative $100 million. 29 of them had market caps of over $10 billion, totaling $655 billion. Saying it again, all the silliness must go. Since that tweet is from 2 months ago, I went ahead and screened the NASDAQ and the New York Stock Exchange for companies with less than negative $100 million in EBITDA. Today, there are 264 companies worth over $1 billion and 47 worth more than $10 billion. So even more than when Michael Burry made that tweet. And what this tells me is that there's still a lot of money tied up in companies with no free cash flows. These are companies that spend too much to acquire their next customer or are still investing heavily in R&D. And there's nothing wrong with that. Some of the companies on this list are incredible businesses: Uber, Shopify, Block, Roblox, Cloudflare. Right now, though, interest rates are making money more expensive to borrow, and any company that needs to raise or borrow money instead of relying on their own profits is getting punished in the markets. And don't forget, that's on top of already lower earnings expectations as we head towards a real recession. But wait a minute, shouldn't the stock market be pricing in everything I just covered? And didn't I just start this episode by pointing out that the S&P 500 rallied by 10%? Yes, and now we've come full circle. So let's just look at a few more tweets. The S&P 500 completed a 22% 2-month rally and the NASDAQ a 43% rally. The S&P 500 would fall another 42% and the NASDAQ another 48% by the bottom post-WorldCom in late 2002. May 21, 2001. Can't shake that silly pre-Enron, pre-9/11, pre-WorldCom feeling. That's from August 14th, almost at the peak of the midsummer rally. But the reason I'm quoting it now is because we're near the peak of a similar rally just a few months later. And don't forget that the dot-com bubble took over 2.5 years to fully pop, from its peak in March of 2000 to the bottom in October of 2002. And during the Great Financial Crisis, the S&P 500 didn't bottom until March of 2009, after going down another 50% over 18 months. And that's exactly what Michael Burry thinks could happen as we head into 2023. We're not even 12 months from the peak today, and the S&P 500 is currently sitting at just under 4,000 points as I record this. In a tweet from earlier this year, Burry said that the S&P 500 could reach 15% lower than the COVID low. That's a Shiller PE ratio of around 16, or a nominal PE ratio of about 9. We're currently at a Shiller PE of 29 and a nominal PE of 20. So, according to Michael Burry, the S&P 500 could go down anywhere from 45 to 55% from where it is today over the next few months. And for the record, I'm not saying that I personally expect the market to drop another 50% right now. But what I am saying is that Michael Burry literally sold every big tech position that he was holding by the end of the summer. He had tens of millions of dollars in companies like Google and Meta Platforms, and he sold them all. That's tens of millions of dollars that he's putting where his mouth is. So we'd be foolish to straight up ignore his warnings for 2023 just because he's the only one making them. What strategy will pull us out of this real recession? What forces would pull us so? There are none. So we are really looking at an extended multi-year recession. Who is predicting this? There are none. Want to see what else Michael Burry has been warning about? Check out this episode next. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to put out more research like this. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.